Hello, my name is Charles Zhang. I'm so happy to present our research result on life consumption and investment with housing, deferred annuities, and home equity release. This is a joint work with Dr. Iqbal Wadley and Professor Andrew Clare from Caspian School and Dr. Muhammad from the University of Brescia, Italy. Over a lifetime, housing is regarded as consumption good, but also as an investment vehicle. Deferred annuities and home equity release products can be used to secure the retirement income, stable retirement income. So an optimal mix of these products can improve an individual investor's welfare. So before starting my presentation, let me stop this camera not to interrupt your attention. Okay. In this talk, I'm going to state research motivation and contributions first, then describe what deferred annuities and home equity release are. When it comes to modeling, I will just explain the objective function. For details, please refer to our paper. In numerical result, you will find how they affect life consumption, investment, and housing decisions. Let me briefly state the literature on lifetime consumption and investment. Housing has been investigated as a factor affecting risky asset allocations of a lifetime. These are renowned papers, in particular Flavin and Yamashita, show that their model can prove an empirically observed hump shape of lifetime risky asset allocation. When it comes to deferred annuities, Maurer and Honeff show how they affect an investor's life consumption and investment. And Huang focuses on purchase timing of deferred annuities, where the interest rates are mean reverting. In Hainsworth's JRI paper, they conclude that home equity release products are welfare enhancing, i.e. they can be an important income source for retirees. However, none of them does not provide a comprehensive model to factor in deferred annuities and home equity release products with practical market frictions such as transaction costs and taxes. So we suggest here the comprehensive model and its implications. Our research aim is to investigate a risk-averse investor's consumption, investment, and housing decisions with deferred annuities and home equity release. We chose multi-stage stochastic programming as a modeling method. The method enables us to integrate financial, annuity, housing, and home equity release markets. And what is more, together with practical features such as no-show selling constraint, maximum loan-to-value ratio on mortgage market, income tax, and transaction costs. In this paper, we make following contributions. First, we provide a comprehensive model of which results are consistent with conclusion in existing academic literature. And second, we find that availability of deferred annuity and home equity release together changes only consumption and housing decisions, but also wealth composition. Lastly, we explain how optimal risk asset weights can change with different product mixes. Okay. Then what are deferred annuity and home equity release? So an annuity provides a regular stream of payments to the policyholder while he is alive. it mitigates longevity risk. Deferred annuities, as in figure, set a deferment period between the purchase date and its first payment date. During the deferment period, the policyholder earns so-called survival credit. So they can be used to reduce longevity risk at advanced ages and also to help young workers to secure retirement income well before retirement. We here only allow deferred annuities can be purchased from age 60 and pay the first payment from age 60, 70, and 80. I have presented housing types here. The first left figure is a traditional housing contract, including shared ownership. It has debt, i.e. mortgage, and a part of equity is shared with another owner, so you should pay some rent to them. In case of full rent, that can be 100% shared ownership. Next two figures show difference between two types of home equity release product. They are reverse mortgage and home reversion. From both contracts, you can receive a lump sum or annuity payment, and you have a right to live at your home for lifetime. The difference is that reverse mortgage involves debt and home reversion involves equity. The debt balance of a reverse mortgage contract is accumulated at a fixed or adjustable interest rate, but cannot exceed the house price. So the policyholder will repay the full amount of debt with his house when he dies. Similarly, home reversion provider will take their house share when the policyholder dies. My model allows mortgage, shared ownership, and home reversion only. Now I'm going to describe our model. So I will explain only Markov model and objective function because I would like to spend more time to talk about numerical result. We use GBM Bostic multivariate Markov model. So equity and house prices follow the geometric Brownian motion process. A short rate is determined by Bostic, and they are correlated. I will present parameters we used in the numerical result. This is the objective functions of our optimization model. This investor makes consumption, housing, investment decision by maximizing his consumption and housing utility. See in the first component. If he is alive, the P is the survival probability. And also make these decisions by maximizing his bequest utility. The W represents financial wealth. We use power utility, so this investor's relative risk aversion is constant. Weighting factor theta determines importance of housing consumption. This investor's maximum lifespan is from time 0 to tau, and retirement date is capital T. A modeling horizon is shorter than his maximum lifespan. Over the planning horizon, decision variables are consumption, housing decisions, including buying, renting, home reversion, mortgage payment amounts, and investment decisions, including cash, bond, equity. And lastly, the annuity decisions, including deferred annuities. Now we are going to look at numerical results. They are presented with bequest and without bequest cases. Following Kraft and Monk, we set these market parameters. They indicate that the long-term mean of the real short rate is 2%, and the bond return shows a mean of 2.7% and a volatility of 7.4%. Equity follows 5% mean and 20% volatility. House price follows 0.9% expected growth and 12% volatility. No correlation assumed between equity and bond, but there are positive correlations between house and stock and house and bond. These are other modeling parameters. Initial wealth is $40,000, and labor income is fixed at $40,000 per annum. Housing price starts at $2,500 per square meter, and the investor currently is age 30. We assume 60% replacement ratio, and there are transaction costs for financial assets and housing. LTV, the loan to value ratio is 80%, and maximum home reversion value is $600,000. To simplify our analysis, we consider only 5 cases. Case A allows only immediate annuity at retirement. Case B allows only immediate annuity and home reversion. Case C only with immediate annuity and deferred annuities. Case D with all 3 contracts. And case E only allows traditional investment housing means. Okay, from our numerical result, this slide shows you averaging housing consumption over lifetime. It is presented by source over ages, and the blue area from house equity and gray from mortgage, yellow from rent, and orange from home reversion. If you compare the case A with B or case C with D, it is clear that home reversion increases housing consumption in retirement on average. This increase is by almost 30%, but the effect of deferred annuity is marginal. Renting decreases than increase with age on average. This supports an empirical observation that young investor prefers renting to owning. This behavior will be clearer if the labor income is stochastic. This shows average non-housing consumption over a lifetime. If you compare case A with C or case B with D, we can find that the deferred annuities increase non-housing consumption in retirement on average. Average consumption is about 5% higher. If we compare them with case E, which is no annuity and no home reversion case, its difference is 20%. That result is not presented here. Next, this presents average wealth composition over the planning horizon from age 30 to age 80. If you see the house asset in indigo color, it is mortgage plus housing equity. The home ownership increases, then decreases. This result is also reproduced by Kraft and Monk and Yao and Zhang. And in third and fourth panels, where the deferred annuities are available, we can find that deferred annuity purchases are actually implemented on average. For example, the deferred annuities denoted by the DA80 in green bar, which start its payment from age 80, their holdings are observed in age 60 and 70. This graph is important in the lifetime investment literature. These three lines represent average equity allocation at different ages for case C, D, and E. They are all hump-shaped. This result is consistent with existing literature. In addition, we observe that availability of deferred annuities home reversion increases equity allocation in retirement on average. Okay. From now on, we will quickly see the same numerical result and figures, but without bequest cases. This shows average housing units without bequest. The investor uses more mortgage debt, see in gray, and on average, enjoy more housing units. This is obvious because there is no bequest motive to save his wealth in a secure part, in secure financial assets, safe financial assets. Investor without bequest motive spends more for his non-housing consumption in early ages. So you can see there between the 30, 40, 50. But as other means to secure income at and after retirements are available, that other means annuities and home equity release. In later ages, the difference in consumption levels are marginal. This chart also clearly shows that in an absence of bequest, there is no incentive to hold safe and less risky assets. If you see bond in pink bars, the case the without bequest shows very small figures than the case with bequest. On the other hand, the former holds deferred annuities more and earlier. See DA80s, that the green bars. Okay, conclusion. I'm back. Okay, we used multi-stage stochastic programming to investigate this type of lifetime investment and consumption problem, which requires so many practical features and state variables, which cannot be handled by the traditional method. And I strongly believe from this talk, you have well found that our contribution below here. I'm quite open for discussion, so please feel free to contact me. Lastly, thank the conference organizers and my discutant in advance. Thank you for your listening and attention. Bye.